Welcome to The Explainer. Today, we're going to decode one of the most important and honestly, one of the most misunderstood financial documents out there, the cash flow statement. This thing tells the real story of the money moving in and out of a business. By the time we're done here, you'll know exactly how to read it.
Okay, first things first, let's get one crucial point straight. Profit and cash are not the same thing. Not even close. You see, profit, over on the left, it's really just an accounting concept. It's figured out using a method where sales are counted when they're earned, which isn't always when the money actually hits the bank. But cash? Cash is real. It's the actual dollars and cents in the company's bank account. This is a huge deal because it means a company can look super profitable on paper, but still go bankrupt because it ran out of actual money.
And look, this isn't just some textbook theory. It's a massive real-world risk. This quote on the screen says it all. Poor cash flow is the #1 killer of small businesses, even profitable ones. They just don't have the cash on hand to pay the bills. This hard reality is exactly why you'll hear accountants repeat one famous phrase over and over. And that phrase is, cash is king. Simple as that. You can have all the profits in the world on a spreadsheet, but without actual cash, a business just can't operate. So that leads to the big question, right? How in the world do we track this all-important cash? Well, that brings us to our main event today. Here's the secret to understanding the cash flow statement. You have to forget everything you've learned about reading a report from top to bottom. For this, we're actually going to start with the answer. We're going to flip the script and go right to the very bottom of the page. Okay, so we start by finding the company's cash balance at the beginning of the year. Let's say, for our example, it was $150,000. This number doesn't come out of thin air, by the way. It's pulled right from the balance sheet of the year before. Think of this as point A in our story. Next, we jump all the way to the end of our story, the cash balance at the end of this year. Again, we find this on this year's balance sheet. And let's say that number is $185,000. So that's our point B.
So the difference between where we started and where we ended is a positive $35,000. The company's cash went up. And that is the entire purpose of the cash flow statement. The whole document, from top to bottom, exists for one reason: to tell the story of how and why the cash changed by exactly that amount. It's the biography of that $35,000. So how does it tell that story? Well, it breaks it down into 3 main parts, or as I like to call them, 3 chapters. Every single cash transaction the company makes, I mean every dollar that comes in, every dollar that goes out, gets sorted into one of these 3 buckets. And here they are, the 3 big chapters: operating, investing, and financing activities. If you can understand what each of these really means, you've basically cracked the code of the entire statement. So let's dive into each one. First up, we have operating activities. You can think of this as the engine room of the business. It's all the cash that comes from what the company actually does. Selling its products or services. It's the cash from customers minus the cash paid out to suppliers, employees, for rent, the day-to-day stuff. A healthy company really should be making money here, consistently. Chapter 2 is investing activities. This section is all about the cash used to buy or sell big long-term assets. So think of a company buying a new factory, or maybe selling off its old fleet of delivery trucks. A growing business will often have negative cash flow in this section, and that's not a bad thing. It just means it's investing money to grow in the future. And finally, there's financing activities. This chapter is all about how a company gets money from and pays money back to its owners and its lenders. So things like taking out a new bank loan, that's a cash inflow. Or paying dividends to shareholders, that's a cash outflow. It's all about how the business is funded. Okay, now there's one more little wrinkle to all this. When it comes to that first chapter, the operating activities, it turns out accountants actually have 2 different ways of writing it. It's like 2 different paths to get to the same destination. And the path they choose really changes how easy it is for us to read. So on the left, you've got the direct method. It's exactly what it sounds like, super intuitive. It just lists out the cash that came in from customers and subtracts the cash that went out to suppliers. Simple, easy to understand. But then you have the indirect method on the right. This one's way more common, but it's a bit weird. It's a clever shortcut for accountants. They start with net profit, that accounting number we talked about, and then they make a bunch of adjustments to work backwards to the real cash number. And because it's so much faster for them, pretty much every big company uses this method. But here's the most important part. No matter which path they take, the final number for cash from operations is always the same.
All right, so we've torn apart the structure. We know the 3 chapters, we know the 2 methods, but let's get to the real heart of it. Why does this actually matter? Why should you care about any of this? Because this one document lets you see past the flashy headlines about profits and understand the true health of a business. I mean, just look at the kinds of questions this statement answers. It's the heavy-hitting stuff. From the operating section, you find out, is the core business actually making real money? From investing, you can see, are they building for the future or are they just selling off the furniture to stay alive? And from financing, you see how they're paying for everything. Are they drowning in debt? This is where the real story lives, way beyond the profit number. So, the next time you see a big headline screaming about some company's record profits, you'll know to stop and ask a deeper question. Is that profit actually turning into cash? Is the business fundamentally healthy? You'll know what to look for, because now you know how to read the true story of a company's cash.